We're told that AI is a brand new technology led by a generation of geniuses. But what if it's not new at all? What if we've seen this exact story before? Because behind the hype, the same billionaire class that rode the dot-com bubble of 1999 is back, just under a different name. Money is pouring in early, long before anyone knows where the peak really is, because no one wants to miss out. And through this hype, one phrase keeps getting repeated like a mantra. This time, it's different. Except, it's not. And it's you that'll be left to pick up the tab. The dot-com bubble promised global connectivity. Instead, it drained $5 trillion out of the NASDAQ between March 20th and October 2002. Ordinary Americans bore the brunt of that. Retirement accounts loaded up with internet stocks lost about 78% of their value over 2.5 years. A Vanguard study found that by the end of 2002, millions of 401k accounts had lost at least 20% of their value. Heavily tech-exposed portfolios were hit even harder. Across the country, tens of millions of American workers were left holding the bag. These were the people who pulled cash out of their homes to chase Pets.com and Webvan and then got margin calls instead of returns. Foreclosures followed, destroying lives all across the country. Most of them never made the news. The NASDAQ peaked at just over 5,000 on March 10, 2000, and then the crash happened and it plummeted to around 1,000. Once you account for inflation, it didn't get back to the peak level until 2018. That is 18 years of lost growth for the people who clung to the dot-com bubble. And now we're staring down the barrel of the same gun. Big tech spending on AI data centers and chips is now over $300 billion a year. The value piled on top of that spending sits in fewer hands than at any time since the dot-com years. Most people assume that this is a brand new cast of characters. It is not. The AI movement is framed as a fresh rebellion led by hoodie-wearing newcomers in San Francisco. The people setting the pace today are mostly the same people who set the pace last time. Only they have 25 more years of contacts, government access, and investors lined up behind them. During the original mania, Reid Hoffman made his fortune through PayPal. Now he's an early backer and former board member of OpenAI. Vinod Khosla rode his Sun Microsystems stake through the late 1990s hardware wave. He followed Hoffman into OpenAI. Mark Andreessen built Netscape and took it public at 24 years old in August 1995. That IPO is what most people see as the official starting point of the dot-com era. Today, he runs the venture firm Andreessen Horowitz, which has poured billions into the current crop of AI labs. What looks like a technological revolution may be something closer to a very expensive piece of theater. And the same fingerprints keep showing up at every stage. When big tech promised the internet would erase distance forever, it felt like a defining moment in history. Money poured into anything with .com in the name. Between 1995 and the March 2000 peak, the NASDAQ exploded roughly 400%. Investors stopped asking whether the companies made money. Revenue barely mattered. Profit was considered outdated. The only thing Wall Street cared about was speed. They wanted to grow and attract customers. They wanted to dominate the sector. The business model and logistics could come later. And then came the crash. Now the AI explosion is reviving that same energy with just smarter machines instead of websites. Massive data centers are burning through electricity to train models that get more powerful every month. And again, nearly all the money is flooding into a select group of companies. The biggest winner so far is NVIDIA. Every serious AI company needs its chips. That demand pushed NVIDIA's valuation into territory that would have sounded insane just a few years ago. By 2024, investors were throwing money at NVIDIA the same way they were once plying it into internet stocks before the dot-com crash. It's not quite as extreme as Cisco at the peak of the dot-com bubble, but it is moving in a direction that feels very familiar. The cash this time is coming mostly from big tech's own bank accounts, not solely venture capital, but it all ends up in the same place. Every bubble sounds good while it's inflating, but which one is the ultimate trap? To understand that, we need to look at the various factors that shaped the bubbles. In 1999, Cisco Systems owned 72% of the enterprise routing and switching market. That means Cisco sold the physical boxes that made the internet work. It was selling the backbone of the internet itself. Every company rushing online needed Cisco's hardware, and the money pouring in proved it. By fiscal year 2000, Cisco was generating nearly $18.9 billion in annual revenue. On March 27, 2000, Cisco hit $80 a share. Its market value surged past $555 billion. For a brief moment, Cisco became the most valuable company on earth, overtaking Microsoft. Investors weren't just buying into a successful company. At its peak, Cisco traded at a price-to-earnings or PE ratio of 201. Imagine paying $100 for a lemonade stand that only earns you $1.25 a year. The stand might be incredible, but the numbers border on fantasy. The whole thing rested on venture capital continuing to flow to the startups buying the routers. When that funding froze in the spring of 2000, the orders dried up. Cisco couldn't handle it. The stock fell about 80% from its peak over the next 30 months. It took Cisco almost 26 years to climb back to that $80 mark. The recovery hit in December 2025. Anyone who bought at the top and held it all the way still lost more than half of what their money could buy. Inflation ate the rest. NVIDIA in 2024 looks eerily similar to Cisco at the peak of the dot-com era. Its chips are shipped by the truckload. Data centers across the world are stuffing racks with NVIDIA GPUs as fast as they can get them. The demand looks unstoppable, but the reality is a lot more fragile. Many of NVIDIA's biggest customers are AI labs and startups burning through investor cash at historic speeds. The rest are tech giants spending billions because they believe AI has to work, not because the profits already exist. That's the part that makes veteran investors nervous. When analysts overlay NVIDIA's 2024 valuation surge against Cisco's climb before the 2000 crash, the curves follow the same trajectory. When two bubbles separated by 25 years begin drawing the same shape, people who lived through the first one tend to pay attention. Most people assume NVIDIA is safe because, unlike the dot-com flameouts, it has real hardware revenue. But Cisco had real hardware revenue and a dominant market share. The 2000 crash didn't come because the router stopped working, it came because the people writing the checks ran out of money. Cisco's peak was actually sharper than anything NVIDIA's touched so far. It should be a warning. The number tells you just how much further the current cycle could still inflate before that same demand cliff shows up. So the machinery looks familiar, but the more revealing comparison is the people making the decisions behind it. During the late 1990s, executives at the biggest tech companies kept telling investors the same story. The internet had changed everything. The old rules about profits and valuation no longer applied. Earnings would eventually catch up to the hype. Meanwhile, behind the scenes, insiders were selling stock. They were small sales, just enough to avoid setting off alarms. At the time, almost nobody paid attention. It only became suspicious years later after the bubble burst and someone looked closer. The numbers, when they finally came out, were ugly. Between September 1999 and July 2000, dot-com insiders cashed out $43 billion of their own company stock. That was twice the rate they had been selling at in 1997 and 1998. February 2024 was a different animal. The camouflage came off. In a single 9-day window that month, Jeff Bezos sold $8.5 billion of Amazon stock. The Walton Family Trust dumped $1.5 billion of Walmart shares over that same stretch. Jamie Dimon, the CEO of JP Morgan, sold $150 million of his own bank's stock. That was his first sale in 18 years on the job. Leon Black, the Apollo co-founder, unloaded $172.8 million, his first sale ever. The combined number for that 1 month came to $11 billion. But it didn't stop there. Mark Zuckerberg offloaded roughly $2 billion of Meta stock across the 4 months heading into that window. One at a time, the moves all looked normal. They were nothing out of the ordinary, but stacked side by side, the people closest to the numbers were cashing out at the same moment. The whole time, public messaging from those same executives stayed bullish, belief in the project. Publicly, they talked about decade-long opportunities and the future of AI. Privately, they were cashing out near the highs. The interviews said confidence. The filings said, take the money. Fortune ran the headline, The Great Cash Out, on February 27, 2024. It was a fitting title. When the people closest to the boom started taking money off the table, it usually means they understand the risks better than everyone else. And unlike 1999, the selling is happening faster and in larger amounts. The people building the boom increasingly look like the people preparing to survive the end of it. But if insiders are selling, who is still buying enough stock to keep prices floating at these levels? In 1999, Webvan built refrigerated warehouses for customers who didn't exist yet. Pets.com made television commercials that turned out to be more memorable than its actual orders. Both companies poured cash into buildings, trucks, and ad campaigns shaped around demand that never showed up. Both became case studies in burning money because neither made it to its second birthday on the public markets. Stability AI is the modern version of those companies. In 2023, it spent roughly $99 million renting compute power from AWS, Google Cloud, and CoreWeave. On top of that, another $54 million went to salaries and running costs. Their total revenue for the year, $11 million. That's a burn-to-revenue ratio north of 14-1. By July 2023, Stability AI was already short on its AWS bill by $1 million. Internal reporting later showed the company had no real plan to pay the $7 million August invoice either. But the cash didn't vanish into a black hole. It moved on a specific traceable route. Venture firms wired fresh capital into AI startups. The startups turned around and handed that capital straight to NVIDIA for chips and to Microsoft Azure for cloud time. Big tech then booked that spend as their own revenue, pushing their stock prices higher. The higher stock prices justified bigger venture commitments, and the next round of money flowed right back through that same pipe. It's what people inside the industry call the circular economy. It might be the single most important trick in the current boom. A dollar leaves a Silicon Valley account and lands in some AI startup's bank account. But it doesn't sit there for long. Within a few weeks, that same dollar usually shows up on Jensen Huang's earning call as growth. And then it helps push NVIDIA's stock higher. And that makes the next venture fund easier to raise. Then another dollar gets sent through the same loop. Most of the money isn't coming from everyday customers buying AI tools because they can't live without them yet. Sure, companies like OpenAI have concrete revenue, but a large part of the money doesn't measure how many people actually use the products. It's measuring the same pool of capital moving back and forth between 5 connected companies. A good example is Inflection AI. In June 2023, it raised about $1.3 billion at a valuation of roughly $4 billion. The investor list read like a who's who of the AI boom: Microsoft, NVIDIA, Bill Gates, Eric Schmidt, Reid Hoffman. Then less than a year later, in March 2024, Microsoft effectively absorbed the company. It paid around $650 million, hired most of the team, and licensed the core technology. Inflection as a standalone business was finished. The investors, though, walked away with 1.5 times what they'd put in. The cash had already passed through NVIDIA's order book and Microsoft's cloud invoices on the way down. The only people who lost out were the late buyers. The speed and design of this cash loop go way past anything the dot-com failures pulled off. Webvan was sloppy in a way the market eventually figured out. What's happening around AI feels different. It's more coordinated, it's less of an accident and more of a system. So who benefits while it works, and who is left holding the losses when it stops? In 1999, day traders opened online brokerage accounts for the first time and rushed into anything that was moving. They were snapping up things like IPOs and internet stocks. Many were buying on margin or borrowed money, so every rise felt amplified. At the same time, the biggest institutions were backing off, but the market didn't fall immediately. It kept going because there was still someone willing to buy at higher prices. That someone was the retail traders. Except they didn't know that. They just saw rising charts and they didn't want to miss out. Instead, they were absorbing the market. The 2024 version is worse. Trading wasn't just about buying and holding stocks anymore. A huge share of activity was people making bets that expired the very same day they were placed. Cboe Global Markets reported that this kind of ultra-short trading became so common it was approaching half of all activity tied to the S&P 500 options market on typical days. Even the 2021 meme stock frenzy didn't reach that level. The market was being gamed in real time, minute by minute. Robinhood spent 2023 and 24 running television ads that pushed options trading into the mainstream. Your cousin, your neighbor, that guy at the gym, the platform was reporting more than 25.2 million funded accounts by the end of 2024. The user base skewed heavily toward traders under 35, clearing more than 50 million contracts at peak times. The favorite tool of the retail trader is no longer the stock itself. It is a leveraged bet. A bet that the price will go up or down by closing time that same afternoon. Most people assume the average investor in 2024 is just like a day trader from 1999, just with a slicker app. But the truth is, it's not even close. Imagine a stadium full of people betting their life savings on a single coin toss every hour, and then they make another bet before the previous coin has even hit the floor. That's roughly the speed of same-day options trading in the current cycle. The public isn't acting like a slow, steady pool of long-term buyers anymore. It's acting like a fast-moving crowd stepping in and out so quickly that it can absorb selling without even realizing it's doing so. That changes the whole system. In the late 90s, retail was loud but relatively simple. Today, it moves faster and reacts instantly to price swings. That means it can absorb a surprising amount of selling without the market immediately breaking. So when early winners and insiders sell now, they don't need a dramatic exit window. There's already a constant churn of buyers underneath them stepping in and out quickly enough to take the other side without noticing it in real time. But what happens if that flow of buyers suddenly slows down? In the late 90s, big tech was at war. Microsoft spent much of the decade locked in an antitrust battle with the US government. The fight was over its decision to bundle Internet Explorer with Windows. The broader industry treated Washington as a problem to manage, not a partner. Lobbying budgets existed mostly to keep federal hands off of the fortunes being made. By 2024, the stance had completely flipped. OpenAI's federal lobbying spend jumped from $260,000 in 2023 to $1.76 million in 2024. That is close to a seven-fold rise in a single year. Anthropic more than doubled its own spend over the same window, from $280,000 to $720,000. According to Open Secrets, 648 different companies spent money lobbying on AI issues in 2024. It was a 41.5% jump from the previous year. The stated reason in almost every case is responsible rollout. The effect, whether intended or not, is that the earliest and largest players end up behind a kind of protective barrier, one that makes it harder for new entrants to compete on equal terms. The clearest moment of all came in May 2023. Sam Altman appeared before the Senate Judiciary Committee. He personally asked Congress to license AI companies. The CEO of a leading AI firm was asking the United States government to require permission slips to build advanced AI. The request lands very differently the moment you ask who would qualify for one of those permission slips and who would not. Smaller companies don't really get a seat at the table when those rules are being shaped. None of them have the legal teams or the compliance budgets to fight back. The rules are written around the needs of a company worth $500 billion. And that is the whole point. The lobbying spend isn't an operating cost. It is the price of permanently killing the competition. The framing dresses up a protection racket in policy language. The big players pay the lobbyists. They help draft their rules. They lock the door behind them and they tell the public it's for their own safety. The same play is running in Europe, just with different paperwork. The EU AI Act passed into law in March 2024 and started rolling out in 2025. A lot of the strictest compliance requirements land hardest on smaller open-source developers and academic groups. Meanwhile, the biggest US companies already have entire teams for exactly this kind of thing. Mistral AI has become the clearest European challenger in the space, and it spent a lot of time trying to influence how stricter rules apply to open models, with limited success. The pattern is consistent on both sides of the Atlantic. Once a rule becomes a law, the story changes. Companies don't need to keep selling the idea of endless disruption at the same intensity. The system itself starts to lock in who can scale and who can't. Competition doesn't disappear, but it becomes slower and more controlled. That takes the pressure off of the narrative that everything has to grow forever. What's different this time is how intentional it feels. You can already see the pieces of the next regulatory framework sitting in draft form through 2025 and 2026, just waiting for the right political moment to move. The trap is built. The only question left is when it springs. So who actually wins when both booms run their course? It isn't the customers. They get cheaper tools, but not the upside. It isn't the small investors who tend to arrive after most of the gains have already been priced in. And it isn't always the companies in the headlines either. Many of them spend the peak years just trying to justify valuations that only make sense in the moment. The real winner is the system around the industry, the mix of capital, infrastructure, and policy that doesn't just take part in the cycle but shapes how it unfolds. The same forces that helped build up the first wave didn't disappear after it ended. They adapted and scaled up. They're now operating inside a second, larger version of the same pattern. What has changed is the scale and tolerance for complexity. The build-out is bigger and the money is deeper. That doesn't make the outcome predetermined, but it does mean that the system can absorb more stress before it breaks and keep running longer while it does. Most analysts can see what's happening. The AI drawdown probably won't begin because the technology fails. The models are getting better. The hallucination rates are dropping. But none of that is the trigger. The trigger is the moment the rules get signed into federal law. Once competition is legally locked out, the big players have permission to change stance. They stop chasing growth and start chasing efficiency. That means mass layoffs. Microsoft, Meta, and Google all announced cuts in the tens of thousands across 2024 and 25. That is a preview of the broader pattern. The story shifts from spend whatever it takes to responsible capital return. That's when the stock valuations drop. The architects keep the cash they pulled out at the top. They walk out with a locked-in market share and federal protection written into law. British investor Jeremy Grantham called both the 2000 and 2008 bubbles in advance. He's been tracking this exact pattern for decades, and he doesn't sugarcoat any of it. Bubbles this size resolve through long, deep drawdowns measured in years, not months. Cisco needed almost 26 years to climb back to its peak. That is the base rate for the biggest stock at the top of a peaked bubble. The history books do not have a V-shaped recovery on file for an unwind this dense. It doesn't really look like a broken system when you step back. It's a system doing exactly what it evolved to do. Money flows in from the millions of ordinary accounts over long periods of time. It gets pooled and concentrated into a small number of huge companies that dominate the market. The people who got in early take their money out along the way. The people who arrived later mostly just ride whatever price is left. And almost everyone is in it whether they realize it or not. Because retirement savings aren't sitting on the sidelines anymore. They're already inside the same trade. They're tied up to the same handful of companies exposed to the same outcomes. Because the people running these cycles have been through this before. Most of the public hasn't, or they were too young to remember what it actually felt like while it was happening. That's what makes this bubble so effective. By the time something feels obvious, it already feels normal. And when the mood finally turns, most people are still holding the same belief that existed at the peak of the dot-com era, that this time the story is too important to slow down. But it's not just the AI bubble that could trigger a financial meltdown. Find out why analysts believe the next crisis may already be building in $39 trillion in debt. Is the American economy doomed? Or watch this instead.